Today we're going to dig into the relationship between stock price and long-term returns. This is part of a series that we're creating to provide more information on the economy, stocks, and bonds. My name is Nathan Haskins, and I'm one of the owners of a wealth management and financial planning firm called Free State Advisors. Today we'll build on research developed by Robert Shiller, who is a Nobel Prize-winning economist, in part based on his conclusions that prices are not always rational and stock returns are not always random. The price to earnings ratio is a common tool that we use to evaluate valuations of a company. It really is just represented by the price of the stock divided by the earnings the company has produced. But those earnings are backward looking, and what buyers are really paying for are expectations of future earnings. There are times where those expectations are way too optimistic and prices are pushed higher in what Shiller called irrational exuberance, and it is difficult for growth to keep up with expectations in some of these cases. Alternatively, there are times where a company's been through a hard stretch and expectations and really the price and valuation of a stock become unrealistically low. Let's take a look at a chart to learn more. Shiller's cyclically adjusted price to earnings, or the CAPE ratio, is the price of the S&P 500 divided by the trailing 10 years of inflation-adjusted earnings. Shiller's data goes clear back to the 1870s, so over 150 years, and this is a monthly chart of the CAPE ratio during that time. The value changes a lot based on what's going on in the economy, what's going on in markets, and frankly, investors' perception of future returns. Over time, it's averaged about 17, and in early February 2024, as I record this, the value is a little bit over 33. So what? Well, we did some analysis on the CAPE and Shiller's forward-looking data and his real returns for the S&P 500 over a forward-looking 10 years. As we looked at these ranges, with CAPE valuations relatively low, so under 15, for the next 10 years, the S&P averaged almost a 9% inflation-adjusted return. Pretty good. In the middle range, between 15 and 30, the S&P averaged about 5.5% a year over the next 10 years. And in the rarefied air, where CAPE valuations are above 30, the forward returns haven't been so good. Now, that doesn't mean that that will always be the case looking forward. You know, we're in that range now. And we don't know how it turns out. But it stands to reason that the higher the valuations are, the harder it will be for companies to live up to those expectations in earnings relative to the price. So the big takeaway from this really is that when we pay a high price and the valuations are very high, the forward-looking returns have been challenged. And when we get a great valuation and pay a low price for a good asset, the forward returns have been very strong. I hope this deeper dive on valuations has been helpful for you. If it has, please share and feel free to subscribe for future updates. Again, while this information is important, please don't take it as investment advice, and remember that past performance does not guarantee future results. If you have any questions, don't hesitate to reach out to us. Thank you.